If you receive RSUs and you're looking to optimize them as much as possible, this episode's for you. Welcome to the Emerging Wealth Podcast, a podcast dedicated to tax and financial education for high-income millennials. I'm your host, John Boyd, certified financial planner and founder and lead wealth advisor at Modern Wealth. That's modern spelled with no vowels, wealth. We're a fiduciary fee-only financial planning firm that runs a flat fee planning model for high-income millennials. So we're talking all about RSUs today, how they work, how vesting works, how taxes work, how you can optimize them, right? RSUs are a way for you to have equity in your company and potentially really increase your total compensation. So again, it is absolutely critical that you understand how they work. So let's go ahead and dive into it. Before we dive into it, if you enjoy today's content, go ahead and go to the description and click on the link to subscribe to our weekly Planning Insights newsletter, where we talk about everything from taxes, investing, retirement planning, estate planning, and more. And of course, you get notified when new content drops. You do not want to miss it. So go ahead and subscribe if you like today's content. So RSUs, let's just start with the basics, right? Because maybe you have RSUs and you're not really sure what they even are. Maybe you just signed a job offer with RSUs and you just want to learn a little bit more. So RSUs are restricted stock units. Now, be aware that if you have restricted stock, that is not the same thing, right? You need to tune out of this episode if you have restricted stock. RSUs or restricted stock units are not the same as just restricted stock. So be aware of that. Now, the good news is that 95% of the time it's going to be RSUs. So don't sweat it too much, but still you want to double check. And RSU at the end of the day is just effectively a cash bonus tied to the price of your company's stock. That's it. Right? That is all it is. It's just a cash bonus tied to the price of your company's stock. So imagine your company told you that, hey, we're going to give you money. It might be more, it might be less, depends how our stock does. And when we give you this cash bonus, we're going to go ahead and just buy shares of our company's stock and put it in an account for you. And from there, you can do whatever the heck you want with it. What if your company told you that? It may not explicitly say that, but that's all an RSU is. So let's not overcomplicate it. At the end of the day, it's just effectively a cash bonus tied to the price of the company's stock. Now, what's neat is that if your company's stock goes to the moon, right now, all of a sudden you have this big cash bonus, you know what's coming on the horizon. So of course, it can make you not only want to stay at the company, but it could also potentially make you a lot of extra money. RSUs can be given out like a traditional bonus, right? So maybe you did a really good job at work and they want to reward you with some sort of ad hoc bonus. So they give you some RSUs. But generally, it's given to you in the form of a grant, and there's time-based vesting. So let's go ahead and dig into an example. So let's say you started a job January 1st, 2023. And you sign your employment agreement and they give you 10,000 RSUs. So you're granted 10,000 RSUs, effectively 10,000 shares. Now, these 10,000 shares, you don't just get them right away, right? That'd be crazy. They just hand you 10,000 shares and you do whatever you please with them. No, they kind of hold it over your head like a little carrot, right? So over the next 4 years, in this example, you have a 4-year graduated vesting schedule, which means that you're going to receive these RSUs in fourths over the next 4 years. So if you want to get all 10,000, you'll have to stay with the company for that entire period of time. So this is how it could potentially play out. So day one on the job, you have 0 shares, right? Vested is the term. When you have vested shares, that means that those shares are all yours and you do whatever the heck you please with them. But day one, you have 0 vested shares. Now on day one, the company stock price is $5 a share, but all of this is irrelevant to you because you don't have any vested shares. Now let's fast forward to year one. Okay, so at the end of year one, now you get your first tranche of shares that have vested, right? Now you actually get some of those, that grant, okay? So now 2,500 shares are all yours. Now, guess what? The company's stock price went up from $5 a share to $10 a share. So 2,500 shares multiplied by 10 is $25,000. So you received $25,000 of vested shares in an account. It's all yours. You can do whatever you please with it. Pretty cool, right? Let's fast forward another year. You get another tranche of 2,500 shares. So now 5,000 total shares have vested. You're halfway to that 10,000 mark. Oh, and guess what? The stock price went up again. It went up from $10 to $15 a share. So now that those 2,500 shares, multiply that by 15, and it's $37,500 in your pocket. You can do whatever you please with those shares, but that's even more compensation in your pocket. So again, you can see here, again, this is a really generous example where I have the stock price just keep going up and up and up. But you can see that if that were to continue to happen, it could potentially result in really serious money. So before I started my own firm, I used to work almost exclusively with executives at tech companies in the Seattle area and San Francisco area. And I worked with a lot of folks that were at some of the big, top 10 companies in the US in tech from the early days. And a lot of them received RSUs. And what happened over the last 10 years, since tech has just gone on an absolute run, with the exception of really the last year-ish, but over the last 10 years, really from post-2008 financial crisis to around, let's call it 2021, those companies went to the moon. And what happened with their equity compensation? It also went to the moon. So their RSUs were very, very valuable at the end of the day. And as a result, I worked with a lot of people who were, in their 30s worth, $6, $7, $10 million in some cases. So again, these are extreme examples, but RSUs can make you very, very wealthy. And again, I've seen it firsthand. So as a great Biggie Smalls once said, more money, more problems, right? So all that money coming in, that must mean taxes. So here's some misconceptions around RSUs. So RSUs are taxed the same as any other form of income. Okay. They don't have some special bracket. You don't have all this crazy stuff going on. They are taxed exactly the same. Now, the withholding on them is 22% on the federal level. So there's a higher amount of tax withholding because it's the same thing as a bonus, right? Bonuses have a higher tax withholding associated with them. Doesn't mean that they're taxed higher. It's just that more is withheld from them. So with the cash bonus, that's pretty straightforward, right? You get a cash bonus, they withhold taxes, and you receive the net amount in a direct deposit in your checking account, right? I mean, that's pretty straightforward. With RSUs, the shares are effectively trimmed to accommodate the tax withholding. So you may have been entitled to 2,500 shares. You'll receive less because they factor in the tax withholding. So nothing too crazy, but you need to keep that in mind. What's important, especially since this is a podcast dedicated to high income millennials, is that a lot of folks think that higher tax withholding is sufficient, right? Oh, 22% is pretty high. Well, I'm good, right? Well, if you're, a married couple making over, let's say, $600,000 as a household, or maybe you're single making $300,000, $400,000, maybe that's not enough, right? Maybe you actually need to be withholding more tax than 22%. Because if you don't, maybe you run into under withholding issues, right? You get a big surprise tax bill at the end of the year. And part of it was because you're not withholding enough on things like bonuses, RSUs, and even your standard paycheck from your salary. So just be aware of that. Just because the withholding is higher doesn't necessarily mean that it's enough to cover your tax liability. So be aware of that. If you decide to hold those shares, right? So once you receive those shares, if you decide to hold them and they go up in value, well, then there's going to be tax consequences potentially if you sell once they have gone up, right? Because you're going to pay capital gains tax on any appreciation. But once you receive them, there's nothing else you need to worry about. So there's no additional taxes. Again, the easiest way to think about it is you received a cash bonus, you decided to buy shares of stock with it. Once you buy those shares of stock, it's upon you what you want to do with it, which is a nice transition to what the heck should you do with the RSUs, right? They vest, they're in an account for you, and it's fair game. You can sell them. You could just let it ride. I mean, you can donate them. I mean, what should you do with them? What should you do? There's really 3 schools of thought here. So I'm going to tell you the 2 most popular ones, and then I'm going to tell you my school of thought on this. Okay. So philosophy one is you don't sell. You simply hold on to all those shares of stock because you've heard friends that have told you that, they're multimillionaires because they have all this company stock. And you also, and this is probably the most common reason, you feel like you're some insider. You think you're special, right? Because you work there and you have all this insight on the company and you know where the stock is going, right? If you're watching this on video, that meme of Buzz Lightyear in the toy store with like 1,000 other Buzz Lightyear boxes around him, you know that meme? That's exactly how I feel when people come to me. They have RSUs. And again, I'm not saying to sell all of them, but I always ask, if you're not selling them, what's your strategy? What's your strategy with your RSUs? And every time I get a story on, well, we're not like other companies, we're doing this, and this, I believe our stocks, supposed to go to this price. So all of a sudden, somebody who's a mid-level manager, who's doing something unrelated to finance at all has now become a stock picker, and they fundamentally understand all the ins and outs of the company's balance sheet. So again, not to poke too much fun, but that's how everyone is, right? Everyone who decides to hold their company stock, most of the time, there's usually some sort of excuse like that. And so as a result, this can lead to people just never selling. They just hold on to all these shares for years and years and years and years and years. Now, if your company stock, goes to the moon, sure, that could pay off really well. But what if it didn't? What if it didn't? You just held on to these shares for years and years and years, and it never panned out the way you thought. But there's always that possibility. So it's kind of tough. So what do you do? So that's the first philosophy. The next philosophy is the polar opposite, right? So there's really 2 people who fall into this camp who believe this next philosophy. And that philosophy is you just sell it all. So the first group of people that believe that are your traditional financial advisor, right? Somewhere in page 50, section 30 of the generic financial advisor guide, it tells you that, if a client has RSUs, you should diversify your portfolio, right? You shouldn't have individual stock. That's bad. That's gambling, you degenerate. How could you? Right? There's also, all the boglehead people online who love index funds, and they think it's absolute lunacy that you would hold on to an individual stock. I mean, are you crazy? Are you gambling? Right? That meme of, everybody at the party and there's that one person kind of in the corner holding like a drink and it's just zoned off thinking like they're superior for thinking that way. I mean, that's how some of these, advisors, some of these people think, is that, oh, well, I'm being savvy because I'm selling all my RSUs, I'm selling all my shares, and I'm going to diversify. That's pretty smart, right? Look, here's the thing. Can you go wrong diversifying? No, right? I mean, there's a reason why people ride so hard for this approach, right? There's an expression in the investment industry that the only free lunch is through diversification, right? You don't know if a company is going to go to the moon. You also don't know if it's going to be in bankruptcy. But what we do know if we diversify and spread out our chips, we can essentially eliminate that risk. And that's one reason why, traditional advisors and some of these people who only like index funds or mutual funds believe that. But here's my approach. And this is philosophy 3. Balance risk and reward. Be real. Balance risk and reward. This is why this is my philosophy, because number one, I worked with the people who held on to a significant part of their RSUs as they vested. I've worked with these individuals. I have seen the millions these individuals have made. Now keep in mind, they're working at, I'm not going to name drop companies, but these are companies that have their stock prices have gone to the moon, and there's some luck involved, no doubt about it. But I've seen people who they're in their mid 30s and they're worth $9-10 million, right? That can happen. It's not incredibly common, but it can happen. And this is why I think it's absolutely critical to balance that risk reward. Because here's the thing. I'm a big believer that taking calculated risk is a good thing. Calculated risk. What do I mean by calculated risk? I mean, just in life in general, right? It might mean you have good household income. Maybe your spouse really likes their job, but you want to start your dream business that could propel your income. You might have a temporary dip in income, but you're going to start your dream business, right? And so by quitting your job that was cushy and comfortable and venturing into starting your own business, right? You're taking a calculated risk. Similar concept here, right? You're receiving all this compensation from this company. You know that their shares could potentially go up significantly. Ask yourself, how much do you want to realistically keep and take that chance? And how much do you want to diversify and take the free lunch, so to say, right? So here's what I want you to ask yourselves when you're trying to figure out, well, how much do I keep? Do I sell all my RSUs? Do I keep half? Do I keep a quarter? Do I keep 3/4? Only you can decide that. So ask yourself this. When those vested shares come in, imagine they fell 60% tomorrow, and it takes at least 5 years for the stock to recover. If ever, right? There's no guarantee it ever recovers. But just ask yourself that. How would you be emotionally? How would you be financially? Would you be okay with that? Would you be okay with having, $100,000 worth of company stock fall 60% and it not coming back? Would that really derail your life plans? Because here's the reality, guys. I've worked with people who have literally 95% of their net worth concentrated in a single stock, right? Not just through RSUs, but maybe they just picked a single stock and they put all their money into it. I once worked with a client one time who had $33 million of a single stock position in their portfolio. It was the vast majority of their wealth. They never even worked at the company. They just bought it. They just bought this company. So with this individual, I mean, we had to, they were so attached to the stock, they just didn't want to get rid of it. But the reality is that if that stock fell 60, 70, 80% tomorrow, they had made peace with it, that they were fine with it. Again, it doesn't mean that I was okay with it. I mean, I was sweating it. Of course, I wanted to try to help reduce that risk as much as possible, but only you can decide that. Only you can decide that. So imagine, how much do we keep? And of that amount that you keep, those shares, imagine they fall and make the decision off of that. Also think about, what would your spouse think? Right? This is kind of underrated in my opinion, because with RSUs, especially when company stock starts doing well, greed starts to kick in. All of a sudden, thinking rationally goes out the window, and you start treating your wealth like a casino. It happens, right? People see their stock going up. All their coworkers are talking about it. Everybody's making money, and you're blinded. You're completely blinded. This happens. People end up with 90, 80% of their wealth tied up in their company stock. And while, we hear about tech and how tech has done well, what if this was like .com bubble, where some of these tech companies never came back? Maybe some of them came back, but it took 10, 11 years. And think about what your spouse would think about that. If your spouse knew that you could have taken the free lunch, the diversification lunch, but you decided to put the most of the family's wealth in your company stock and it fell apart, would your spouse be okay with that? And the reason why I'm using this example is that I've been in meetings where the stock went sideways and the news has to be broken to the spouse, or the spouse is just now finding out about it. And it causes issues because you and your spouse are a team. You guys are working together towards financial goals that you have set out. And you risking all of that, maybe your spouse is not okay with that. So when you're making this decision on how much of the company stock to keep, right? Again, I'm not saying just sell all of it, right? Is that the easy route to take? Of course, right? Diversification is the only free lunch in investing. But I also understand that there's that chance of maybe going to the moon, right? Balance that and make sure your spouse understands what that plan is as well. I also want you to ask yourself, how does that company stock serve you? Right? Because people get so caught up in building wealth and, the dollar amounts that are starting to build up in their accounts, they completely lose sight of what's the purpose of doing all of this. Why do we go to work every day? Why do we work hard to get these RSUs? Why do we stick around at these companies to get these RSUs that vest? Why? What's your why? Maybe you want to give your family the life that you never got to have. Maybe you want to travel the world and do things that you never got to do growing up. Maybe you want to buy your dream home. Maybe you want to retire early and achieve financial independence. Whatever that why is, your investments should be serving that purpose. They should be serving you. Because if you don't have that why, you end up just serving your investments. You end up checking your phone all the time and looking at the balance and not knowing why you're even doing that. Ask yourself, what is the why? What is the purpose of what you do? And how does that stock, that RSU, serve your overall portfolio, your overall investments? If selling that stock makes more sense and it serves you more, maybe that's the route to go. If selling half and keeping the other half so it could potentially appreciate significant in value is the better way to go, that serves you better, then go for it. I don't care which way you take, but it better damn well serve you. I hope that really resonates. So bottom line, guys, RSUs are an extremely powerful tool, right? Really powerful way to potentially build wealth through your job. Taxation wise, you need to be really aware of what your income is because the withholding on them might not be enough. But I promise you, if you have a cohesive game plan for them, you'll allow that plan to serve you. I hope you enjoyed this episode. Please subscribe if you did, and I hope you have a great rest of your day.